Hello and welcome to Wall Street Vision. On this show, we explore the thinking of the best investors and we examine lessons from the stock market. I'm your host, Vlad Dolgochev. This show is for informational purposes only and is not investment advice. Check out the show notes for the full disclaimer. Hello, everybody. Thanks for joining me. In this week's episode, we're going to cover the go-go years of the US stock market. This was a wild time where portfolio managers were saying stuff like, you can buy a stock at any price and still make a good investment. So crazy that professional investors actually thought that. We'll cover the Nifty 50 stocks and the key takeaways from their boom and bust. And we'll also discuss why expensive-looking stocks can still be undervalued. Let's dive right in with a story. So the 60s were an interesting time in the US. The quality of life was getting better and better, as people with an average income and no college degree could afford TVs, radios, cars, and houses. In some ways, it was easier back then than it is today. The 60s had a space race that got a human being to walk on the moon. And there was a big boom happening in the stock market as well. These years were called the go-go years on Wall Street. The older Wall Street folks retired, and lots of young people flooded the investment industry. Something like half of all salespeople and analysts on Wall Street started their financial careers within the previous decade. And most of the portfolio managers had less than 5 years of experience. People didn't know this at the time, but this was a problem. Because during their careers, they had not gone through a prolonged bear market. They were also relatively inexperienced and probably had a higher risk tolerance than the old brass who were on the way out. It's one thing to read about bear markets in books, but it's another thing to experience them yourself and lose money or your job in the process. The lessons that people learn firsthand are always the ones that stay with them the longest. Of course, the stuff people read in textbooks is there on an intellectual level, but those textbook concepts are usually a little fuzzy and not top of mind. The post-World War II boom in the economy led to tons of innovation happening. During the early 70s, there was a group of about 50 stocks that were called the Nifty 50. The Nifty 50 were companies that were growing quickly, and professional investors were saying that you can buy these stocks at any price. They were literally called one-decision stocks that you buy once and never sell. Portfolio managers loved these stocks because the stocks were earning crazy returns, and the majority of the professional investors were going, listen up, everyone. These stocks are a sure thing, so I'm going to back up the truck and buy as many shares as I can get my hands on. Their perspective was that if the stocks crashed, they'd take the whole market down, and the portfolio managers would not lose their job because pretty much everyone had this rosy view of the future. So it was the sort of situation where most of the professional investors were in this together. Digging a bit deeper, the logic was that these companies were growing so quickly that whatever price you buy them at, the earnings of the companies will keep growing super fast, and that will lead to the price you paid being okay, even if you ended up spending a lot on each individual share of the company. If you look at the list of these Nifty 50 stocks, you'll see that a lot of them are still around today. And a lot of them have done really well. You have companies like McDonald's, Coca-Cola, Pfizer, IBM, and Pepsi. But you also have companies like Polaroid and Eastman Kodak that haven't done so well. So you had these big name institutional investors that are supposedly the smart people in the markets paying crazy prices for these stocks. The Nifty 50 stocks were on a tear from 1970 to 73, and you probably can see where the story is going, right? Then there was this crazy bear market that took over. During the bear market, those companies lost a lot of value. I'm talking 60 to 80% decreases. So at the time, a lot of investors were freaked out by this, and they dumped their Nifty 50 shares. Lots of investors lost their shirts. That massive panic caused these companies to get really undervalued for many, many years. Monish Pabrai talks about how markets go from being too fearful to being too euphoric, and they don't spend too much time in between. Well, that's a perfect way of interpreting what happened to these stocks. They went from being overvalued to being really undervalued and stayed undervalued for 20 years plus. The interesting thing is that for a long time, people used the example of these growth stocks getting crushed as a reason to stay away from growth companies that seemed expensive. Before I go on, let's take a quick moment to discuss a super simple way of telling if a company is expensive or cheap. The easiest and simplest way of doing this is to look at a company's price to earnings multiple. It sounds fancy, but it's actually really simple. Of course, this is just one small way to determine if a company is expensive or cheap, and investors would look at lots of different ratios to form the full picture. But it's a super simple, quick and easy way to check where the company might be in that expensive to cheap spectrum. The price to earnings multiple is a ratio that a lot of people use when they're trying to put a value on a company. Essentially, it's how much you'd pay for a dollar of a company's earnings. The price to earnings multiple is also called the PE ratio, or simply people refer to it just as PE. Are you with me so far? It's a simple ratio that shows you the price of a share divided by the earnings per share. So if the price to earnings, or PE, is 60, and you buy one stock, you'd be paying $60 for each dollar of earnings that the company has. At the peak of the Nifty 50 era, the PE ratio for the Nifty 50 was more than double the PE ratio for the rest of the market. Since the Nifty 50 had a higher PE, those stocks seemed to be expensive compared to the rest of the market. After the Nifty 50 stocks had their crash, for many years lots of people were saying, that's the proof that you don't want to buy expensive companies with high PE ratios. People on Wall Street were saying that a company that has high growth and a high PE ratio is overvalued because you can have the same type of crash situation that happened in our story. That was the dominant form of thinking for many years. The interesting thing is that even today you still have people talk about the Nifty 50 as an example of why you want to stay away from companies with high PE ratios. And look, those people definitely have a good point. If you bought Polaroid for a PE of 95 in the 70s, you would have lost most of your money. You would have paid $95 for each dollar of earnings that Polaroid had, and that was way too much. As a comparison, the historical average PE of large US companies is around 16, and Polaroid was really expensive when it was selling at 95. Here's where things get interesting. In the late 90s, Jeremy Siegel, he's this finance author by the way, well, he came out with this research where he went back and looked at the Nifty 50 stocks, and he was trying to figure out what your portfolio would look like if you bought all 50 of them at the very peak of the market, and then just held them for the next 25 years. He found that if you did that, your return would have been almost the same as the return on the overall broad market. That's a really interesting finding because people to this day still talk about how the Nifty 50 is an example of why buying companies with high PE ratios doesn't work. But Jeremy's research showed that wasn't necessarily the case. Before we dive into the other things that Jeremy Siegel discovered in his research, I'll quickly mention that if you're enjoying the podcast, please give us a rating and hit the subscribe button. And if you know someone who would find this content valuable, please share this episode with them. My goal for the podcast is to help people learn the lessons from the best investors and to help people understand the stock market better. I think that's really important today as there's lots of information out there that can lead people on the wrong path, and I would love for more people to benefit from this type of content. Alright, back to Jeremy Siegel's findings. His research showed that when taking a closer look at the Nifty 50, some companies did terribly and they were overpriced. But some of the best companies at the time, like Pfizer and Philip Morris and Coca-Cola, were actually undervalued, even though they had really high PE ratios. As an example, Coca-Cola had a PE of 46. But an investor could have bought it for a PE of 82, and that still would have given them the average index return over the next 25 years. Now, the really interesting thing to me is that after the crash, these Nifty 50 stocks were undervalued for the next 20 years or so. Investors lost confidence in them and didn't want to buy any of those stocks. But an investor that would have bought the Nifty 50 portfolio after the market crash of the early 70s would have done way better than the index because the stocks were so undervalued and many of those companies were actually really high quality companies. There's a few other great lessons that Jeremy's research discusses. If you're going to own a growth company, it's going to be expensive to buy it, and the great growth companies might never become cheap compared to the rest of the market. But that doesn't mean that an investor can just pay any price for a stock. Polaroid had a PE of 95 at the peak, and its PE should have been only 12 if you looked at the returns for that stock going forward. But even an expensive stock can be a good buy. Coca-Cola in the early 70s would have been a good purchase even if an investor bought it at a PE of 82, which just seems like a ridiculously high PE ratio, but sometimes it's warranted if the stock does well for many years afterwards. Even if you bought Coke for that really high PE ratio and held it for the next 20 plus years, your returns would have been about the same as the overall market returns over that time. The other lesson here is the importance of diversification. In the early 70s, it would have been hard to pick out the individual winners on that list of 50 stocks. Surprisingly, the biggest winners were a tobacco company, a drug company, and consumer staples companies. Those boring industries beat out the tech companies on the list. That's why a diversified portfolio can save an investor if they make the wrong stock pick. If somebody bought all 50 of the Nifty 50 stocks at the peak and held them for the next 25 years, they'd do well. But if they bought only 10 stocks at the peak and 4 of those were poor performers, that investor's portfolio would have gotten crushed. The last important lesson here is the importance of time. It took around 25 years for the Nifty 50 portfolio to recover fully when you compared it to the broad index. And that's a reminder that time is a crucial component for any successful investor. One of the reasons Warren Buffett is so rich today is because he's been investing since he was a little kid. Compounding his money over 80 years has made a huge difference. Same thing with the Nifty 50 stocks. Someone who bought in at the peak would have done okay if they just held their investments and didn't touch them for the next 25 years. When I was reading up on this topic, right away I started to think about the dot-com bubble, and I wondered about the difference between the Nifty 50 and the dot-com bust. I think the biggest difference was that the Nifty 50 had realistic growth prospects, and there were companies that were actually making money. The dot-com bubble was an insane level of speculation where companies that didn't make money were raising tons of cash from people who were essentially gambling. As an example, in the late 90s, the PE ratio of the tech sector in the S&P 500 index was around 90, so it was more than double the PE ratio of the peak of the Nifty 50. The Nifty 50 had more solid products and business plans, and it was an overall less speculative environment. It was much less of a gamble. During the dot-com bubble, retail investors started day trading as well because all of a sudden they could do it through the internet. I think that was something that really fueled the fire in the dot-com bust. If your plumber neighbor made a 30% return in a week investing in some high-flying tech company, the fear of missing out would be a really big thing pulling people in to act on the latest hot stock tips. Alright, Vision Nation, that wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button, leave a review, and if you know someone who's interested in investing, please share this episode with them. Thank you so much, and I hope you have a great day. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. I may maintain positions in the securities discussed on this podcast.